This is the Nedgroup Investments Podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you. Welcome to the Nedgroup Investments Podcast. Today we have Andy Headley from Veritas Asset Management, who have been running our Nedgroup Investments Global Equity Fund for over 10 years now and doing a fantastic job. Today we're going to have a quick chat about a couple of the sectors that Veritas team have been looking at recently. And so Andy, welcome to Cape Town, and tell us a bit about your focus on consumer staples and your comments that you made recently on brand loyalty.
Yeah, I think since probably 2015, 2016, there's been a concern that consumer staples companies are losing brand loyalty and therefore losing market share to kind of some of these startup challenger brands that you see around. And we hadn't owned consumer staples for many years, partly due to valuation and partly due to those concerns that the barriers to entry were reducing. So the barriers to entry in branding and in distribution are both declining. And so we were a bit concerned about that. And given the valuation, we didn't own them. Since 2016, the valuations have come back markedly as people have become concerned that they are losing brand loyalty, that the barriers to branding and distribution are lower. And so that meant the valuations became quite attractive. So we started doing more work on it. And what we think we've identified is that the mass market is actually really, really difficult to penetrate for new brands. So whilst new brands can come in at either the high end, which is most likely, or if you're private label at the very low end, and you can take a bit of market share there, it's really, really very difficult to take market share in that mass market segment. And we think people have overestimated the risks to these consumer staple companies because of that. And so we've invested in a number of them. So Unilever, Nestle, Reckitt Benckiser would be three of them.
Okay. And so is this product in all avenues, or is there a certain type of product that people have perceived this is affecting?
Yeah, it's actually, we've seen it across the board. So we've done a lot of studies. So we've looked at things including luxury. So we've looked at some makeup brands where we see them competing with things like Estee Lauder. And there is some at the high end, there is some ability for new entrants to come in. We've also looked in more the mass market. So things like, everyday products, mayonnaise, washing powders, those kind of things where it is possible to take a small market share at the high end. Most of these sectors, the low end of the market has already gone to private label. But at the high end, it is possible to take some market share as a new brand. But what we found was that there's a real barrier to scaling. And so you can get to a certain size at the very high end where people are prepared to pay a premium for a very premium product. But then you come across what we think is really what we've termed the inverse of the innovator's dilemma. So the innovator's dilemma was basically where you launched a product that wasn't quite as good as the product already in the market, but it was a lot cheaper. And then you grew into that and took market share. And obviously, Clayton Christensen, with the book, identified how that could erode the market share of the major brands, or in that case, in IT. And so we think what we see is the inverse of that, in that these companies come in at the top end. And the dilemma for them is it's very difficult once you're charging a premium for a product to then go down market to the mass market. And so we think it's actually very difficult for these premium entrants to attack the mass market.
Right. Okay. And we've seen a few of the larger companies, the likes of Unilever, you mentioned, try to tackle new entrants with various initiatives. Can you describe what they might be?
Yeah, so they've got a couple of things. Actually, I think probably all of the consumer staples companies are now doing this. Probably Unilever are one of the best, if not the best. Mm. So the two things that they've essentially done is, first of all, they've become much more competitive and quicker in the way that they innovate. So if they see a new product that might threaten them, they will innovate very quickly and come out with a copycat product very quickly. So a good example of that would be something very mundane like mayonnaise. So most people know Hellmann's mayonnaise. It's market leader in most countries that it's in. And there have been some new vegan mayonnaises, so no egg mayonnaise, which sounds slightly strange. And they were taking a little bit of share at the premium end. To put it in perspective, there's a brand called Just Mayo. They charge $16 US dollars for a normal sort of 12-ounce mayonnaise, which compares to about $3 for Hellmann's mayonnaise. So Hellmann's innovated, or Unilever innovated very quickly and came up with a vegan mayonnaise that they sell for about $4.
Right.
So whilst there are some people out there that will buy just mayo at $16, Unilever have come out with a product that is just as good and is a quarter the price. So they're innovating extremely quickly. The second thing they're doing is where they identify a new entrant or a company that has something very innovative, they are acquiring those in a VC, so a venture capital type way. And what they're aiming to do is that even though they're paying quite high multiples, typically the companies they're buying are only in one country. And so what they're able to do is buy that product and its marketing and its branding, and then extend the product through all of the countries that Unilever operates in, particularly in developed markets. And so they can leverage up their own infrastructure, which allows them to pay quite high prices or quite high multiples for the initial purchase. And so those two strategies are allowing them to attack the innovators and the challenger brands.
And that infrastructure you talk about is not to be underestimated, right? Because now we're talking about global distribution. And we're not talking about just to develop markets either, are we? We're talking about...
No, it's absolutely right, Rob. So Unilever has just huge distribution across the globe. And most people, when they think of Unilever, they think of the branded products you see in supermarkets. But actually 60% of the products that Unilever sell are in emerging markets. And they're typically single-use sachets. So it might be a single-use sachet for shampoo or stock cubes, because that's how people in emerging markets tend to consume these things. And so 60% of all products that Unilever sell are across those emerging markets, and they have this vast distribution network in order to allow them to be sold in many, many millions of retail outlets. And so that's really difficult for a new entrant or a challenger brand to compete with. I mean, nobody else has that type of infrastructure to allow people to distribute across such a wide array of retailers.
And we're not talking about them owning the logistics, though. Or just the connections? In
some countries, they own logistics, but in most countries, they have connections that allow them to use third parties. Right. So it's a mixture of owning the infrastructure and using third party.
Right. Okay. Thank you. Nedgroup Collective Investments is an authorised collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.